Okay, so do you guys see this part? The whole whiteboard thing? I pretty much go through the first half of the question except for the last step. So the last step, I'm just saying that, now I have to erase the whole thing, that this 44.426, which is the value, the present value of the whole portfolio, should be equal to the delta shares of the stock today minus, because you short the call, minus the call function. So that should be equal to 0.551, which is delta, times 100, the stock price today, minus the call today. And that's why we solve for call price. It is equal to 10.674. Make sense? And the last part, I asked you to calculate the U and the D. In that case, I'm giving you the possible stock price up, possible stock price down. And since S is equal to 100, and the U times S is 122.4, so U is equal to U times S divided by S, which is 1.224. And similarly, D is 81.71 divided by 100, which is 0.8171. Okay. Melanie, what do you think? Is it okay? Cool. No problem. Any other questions? You have any question? Please ask. Yeah, right now. Why not? Everybody's listening. Phone is in my office. Let's see. Example for upper boundary arbitrage. Ooh. So the upper boundary for the call, what is it? It's the stock price, right? How about the put? Should be the K, right? Okay, so suppose we have a stock or we have a call. Call price, suppose, let's say if call price is greater than S0, okay, that means the call price is too high. So too high, and so you short call. Short the call. Okay, if you short the call, then you long the underlying. Long S0. And in order to get that, what do you get? Well, since now the call is greater than S0, so you get SC minus S0, this whole thing is greater than 0. This is a positive, because remember now you have a call price that's greater than the stock price, right? So if that is the case, you take that and put it in the bank. Which turn into how much? C minus S0 exponential RT at capital T. And on top of that, remember, you have one stock. You also have one stock. And you also short a call. And if your short call is exercised, that means your counterparty is buying the stock at strike. So you sell this one stock that you're actually having, sell it, and get stock for strike price. Okay. So overall, you are going to have C minus S0 exponential RT plus K. See, this first term is positive, second term is positive, both of them positive. If not exercised, then you just have a stock, and you can sell it in the open market, and that should be greater than 0 too. So either way, you're gonna get positive profit. That's how you arbitrage, to successfully arbitrage, and that's why the call price has to be less than 0, the current stock price. Okay, so suppose the put turned out to be greater than the strike, and if that means the put price is too high, right? So P is too high. So we are going to sell put. When you short the put, you short the stock. So you go, the call and the stock goes opposite direction. The put and stock goes the same direction. So if you long the put, you want to long the stock to cover it up. If you short the put, you want to short the stock to cover it up. So you short put and short stock. That gives you P and the K. Oh, sorry, P and the stock. Okay. Again, you have something positive. Put it in bank. So at expiration time, you now have P plus stock exponential RT. Okay, and you also have one short put, and one short stock. And if your short put was exercised by your counterparty, then you have to, which means your counterparty chose to sell the stock, to sell one share of stock to you at the strike price. So if it's exercised, you pay the strike price to buy. You're actually obliged to buy the stock. And after you bought that stock, you can return stock to close out short position. So at that time, what do you have? Well, you have P plus S0 exponential of RT minus the strike. Okay, and since P itself is greater than the strike, remember, so the P exponential RT, which is compounded P, should also be greater than strike, and plus a positive S0, the overall thing should be totally greater than equal to 0, or if I will, greater than 0. Okay, if it's not exercised, then what you're going to do is you are just going to pay ST to buy stock and also close out short stock position. Let's see if I can. Okay. So that is the case. All of a sudden there's some noise here. That is the case, and close the whole thing. If that is the case, remember we have P and the stock exponential RT minus K, right? This one is greater than 0 because P is greater than K. So that's what we start with. So now when it's no exercise for put means what? The put is out of money. When a put is out of money, then ST must be greater than K. Makes sense? So now, if it's no exercise, then you have overall profit of this whole thing minus capital ST. Okay, so I want to prove that this one should be also greater than 0. Huh? This one?
Yeah, and above you have that one greater than 0, so minus ST will be greater than 0.
Well, this one is actually less than this one. So which part went wrong? Well, we had exercise, which means we were obliged to buy the stock at a strike to pay K. If no exercise, no exercise, ST. Something's wrong. I don't know what. Oh yeah, so this one is greater than K plus S2 exponential RT minus ST. Good question. You guys, any suggestions? Okay, let's see what the book says. Well, now that I just worked through it, Logically, it definitely is true, but what part went wrong? Security. Price you're paying the put to actually, and paying the put and paying the strike. Right, so right, that part is definitely right, and there's no exercise for put. You short the stock. Okay, we have an example when the option price is out of boundary. What is the arbitrage you would use? Well, I thought that was what I was working right now, Jenny. Let me take one moment and think it through. So we had a put price that is greater than K. Okay. And the put is too high, so you show the put and short stock. You get put in stock, put in the exponential YT. At the end of the day, as T is less than K, then exercise. So at K, you short stock, long stock, check the put. Sorry, yeah, I'm on an online session. So. Yeah, so let me see. Should I long? Thank you. So if I'm gonna long the stock, that is greater than K. I know. If it don't exercise, it doesn't make sense if they don't exercise. Minus ST. I may have to think about it. Actually, this one I'm stuck. To prove that it is greater than 0, you have P is greater than K, and K is greater than ST.
We have to buy.
Oh, there. Sorry. No, K is not greater than ST. When at the stop price, when it's short. Yeah, I need to think about this one. When we short a put, I think I got the position wrong. We short the put, you need to put long the stock, long the put, short the put, short the stock. That's right. I need to think about this one. I promise I won't put it on the exam. Okay, so have an example when the option price is out of its boundary. So what we've been talking about, what we just talked about here is when it is out of the upper boundary, so when it's higher than the upper boundary. If it's lower than the lower boundary, which is more commonly seen, it's a little bit easier. So suppose if the call price, remember it's boundary, right? It should be as 0 minus k exponential minus RT. Okay. Right, so this one, if the call price is even lower than that one, then the call is way too cheap. So then you long the call. And if you long the call, what do? You're going to short the stock. You short the stock, then you're going to take the stock price minus C. Since the call is way too cheap, the stock price minus C has to be greater than 0. Okay, so we take that, put it in the bank, deposit in bank. So we get S0 minus, at the capital T, we have S0 minus C exponential RT. Okay, then at capital T expiration time, what do we have? We have one long call, one short stock, and we have this amount of cash. Okay, so if it's exercised, which means it's in the money. If it's not exercised, it's out of money. Okay, if it's exercised, you are going to, if it's in the money, you exercise it using your long call, which means you buy stock at the strike and return to close out short stock position. And what do you have? Well, you have cash in the bank minus the strike. Okay. If it's not exercised, no exercise. And this one is exercise. If it's not exercised, you buy stock at ST and to close out short stock position. And this one. So to the left hand side, this whole thing is greater than 0 because if you extract exponential RT out, you get S0 minus K exponential minus RT minus C. Okay, and since the call is less than this boundary, so this boundary minus call should be greater than 0. And on the right hand side, since this one is minus ST, which is when it's not exercised, ST is less than K, so you minus something that's smaller, this one should be greater. Which is in turn greater than 0, which is proved on the left hand side. Okay, any question?
So is that what you expect from us in the specific case that you put for the essay?
I cannot hear you very well. Can you type? Sorry. Okay, is an example like that what you expect in this specified case? Yeah. Except for in the specified case in the essay question, I will give you numbers. So instead of working totally through those formulas, you will need to have detailed numbers to put in there. So you actually carry out the calculation to really show that the final answer is greater than 0. Okay. Any other questions?
So you said there's, well, I know like last exam you gave us 2 options for essay questions. Um, what were the possibilities? Did you give us those options as well, or we just kind of have to figure that out?
What do you mean?
So like last review, you gave us examples of the essay questions you're going to ask us, and I didn't see on the review like example essay questions. So I'm just curious if, I mean, unless I missed it, but
Well, isn't that in a specific case, if the option price is out of its boundary, what's the arbitrage strategy you will use
okay.
on the review list?
I guess my main question was if there's anything going to be on the exam that's not on the review.
Anything on the exam that's not on the review? You think I will do something on that, like that?
No, but I've seen it before, so I'm just curious.
Not
Not in this class, but anyway.
Well, I haven't looked at the exam, but since Fawn is here, I cannot open and look at it. So.
You can leave.
Fawn is so sorry. And yeah, in general, I just try not to surprise you on the exam. I try to surprise you in the classroom though. So hopefully the classes are more interesting than the exam. The exam can be pretty boring.
Can you have a particular strategy, or we just have to look at like all the strategies? Could you have only the strategies for the
For the calculation in the review list, calculation number 4, calculate the profit and or payoff of a strategy. So on that question, I'm looking at specifically on the spread and the protective put or covered call. So especially the bull spread, bear spread, and butterfly, and protective put and the covered call. Yeah.
Thank you.
Okay, one last question. People, come on.
Hold on, give me a second.
1 second is gone. Sure, please go ahead.
For this one,
Uh-huh.
so why don't we just use the normal way, like this is a K, right? This is greater than K, so then we just subtract it from 21 and
You
get 1.
mean in the middle part,
Yeah.
in the middle step?
We cannot do that?
If it's a European option, you cannot exercise though. Right? So
Right.
if it's an American option, then you need to do both ways to see which one is higher.
So it's not the same amount.
It's not necessarily the same amount. So the amount that you get from the ending branch might be higher or lower than the value, that the payoff you will get by immediate exercise. So if that is the case, if it's lower than the immediate exercise value, then you may choose to immediately exercise. So yeah.
Yeah.
For American option is more tricky, but for European option, you can't do
Yeah.
anything in the middle. Yeah.
Thank you.
So going back to European options, since a lot of the strategies involve European options, they can't really be utilized on the project, correct? Or
Yeah. Oh, definitely. Yeah, but just be careful. As a lot of things traded online, those are Americans. So
right. Well, because if I've placed a few trades online, but some of them just get canceled at the end of the day because I don't know if it's no one wants to purchase my trade or whatever the case is. So I don't know if the system's automatic or there are actually other live traders using the platform, or how does that particularly work?
I have never used it before, but usually if it's closer to the strike, if let's say that if it's a strike price that's closer to the current stock price, it will be more liquid. There will be more trading on it, and you have higher short on that.
Okay, so if I have a higher strike than the current market price, it doesn't mean or necessarily mean my trade will be processed.
I don't know. That's a question for the help desk maybe. Yeah, I will really need to go through because it's a simulation, but I would guess it's a pretty realistic simulation, and maybe they involve certain level of like a market volume in there or like open interest in there. So I don't know.
Just a question about
Sure.
the homework.
Mhm.
Do we need to do part C because we didn't have the
Derivative?
Yeah.
Did I make it available to you guys? Let's see. Derivative. Not yet. I can make it available. And you can play with it. It's basically an Excel sheet with macro. So you can use that. You can verify your other homework questions.
Thank you.
Okay. Okay. So if there's no question, have a nice evening, and feel free to email me in the future. And good luck and the test preparation.
Thank you.
Thank you for coming. Bye. And let me stop the